get across the market open. Kyle Ryder joining us from capital.com. Kyle, welcome. Good to see you again on AusBiz. Not a lot of news to trade on. We did hear from the White House that they're saying, look, essentially the ball is now very much in China's court.
Yeah, very much so. And we're sort of seeing now the kind of more tactical games being played by the US and China when it comes to kind of trying to turn the screws, so to speak, on this trade war. This morning, there's been some fairly significant developments where NVIDIA has said that the US has banned exports of its H20 chip into China, which is now moving futures to the downside. And we're probably going to see the ASX 200 maybe open on a fairly nervous footing because now we're seeing a very much a focus on tech supremacy and the tech element of this trade war coming to the surface once again. So I mean the markets didn't move much last night. They haven't moved in the last couple of days. There's this kind of relief that maybe there's a bias amongst the Trump administration to step back from the precipice a little bit, water down some of these trade restrictions, albeit the big imposts remain primarily on China, with obviously some fairly key exceptions. But we're getting to kind of the more slow burn, corrosive part of the trade war now, which is we've got these big, volatility generating announcements that have clearly put the markets to this point, sparked the sell-off to this point. But now we're starting to see, the kind of other incremental policy changes coming through from both sides, the Boeing ban and what have you, and also, the potential that it's going to start showing up in data, corporate and macroeconomic, and we're starting to, really see the dust settle and what damage is being done by this trade war.
Equity-wise, look at focus returning, I guess, to earnings, given the banks have kicked that off. But look, it's difficult, obviously, for companies to make, particularly given any guidance, given the uncertainty at the moment.
Yeah, and that seems to be what we're going to be getting over the next few weeks. Whatever corporates deliver for the last quarter or so, is that guidance is going to be increasingly difficult. I mean, we heard it over the last couple of days that, on balance, companies think that things are still going to be okay, but, if the tariffs are kind of applied at the current rates or something similar, that there's downside scenarios potentially in a recession, for example. I think United Airlines was one in the last couple of days talking about it, where if all of this sort of does come to fruition, or the worst case scenario comes to pass, then there's going to be a fairly significant to these businesses' bottom lines. So this is going to be, I think, the theme of the next 2 or 3 weeks, and kind of the second phase now of this, the impact of tariffs and the trade war, is that we've got the initial shock. Maybe there might be some concessions and negotiations going on, which means that the full suite of tariffs announced on Liberation Day might not come into effect. But still, what we're going to be seeing is the impact of the uncertainty on activity and guidance, and then obviously also just the impact of the tariffs themselves on company bottom lines and the macroeconomic data. So it's really now in that kind of phase where we gauge the damage, and at the moment the very early signals is that the damage could be fairly significant, and that indicates potentially the bottom for equities isn't in just yet.
Now locally, I guess the focus this week really will be on jobs data tomorrow.
Yeah, and I think the RBA set us up in its minutes yesterday for basically a May rate cut. The one bright light for the Australian economy over the last few years has certainly been the resilience of the labour market, but we're expected to see some signs of perhaps loosening in the labour market coming in the recent set of data. Tomorrow is expected to show that the unemployment rate ticked up to about 4.2%, albeit on some fairly robust jobs gains. But if you go back to the minutes yesterday, they sort of suggested that the May decision would be an opportune time for the board to sort of reassess policy settings, which comes to no surprise to anyone, really. We know that the RBA has been setting policy according to the official CPI data. Of course, it comes out quarterly, and there is widely expected to be a number for this inflation figure in 2 weeks' time, or whatever it happens to be, that will come in within the 2 to 3% target bands, and all but give the RBA the green light to cut interest rates. So if we see, maybe some resilient jobs data tomorrow, that might get watered down somewhat. In saying that, though, there is, clearly the focus on inflation. It's expected that inflation data is going to come in, again, between 2 and 3% on a trim mean basis. And not only that, there is building downside risk to the Australian economy because of, the trade war uncertainty and a slower global economic growth backdrop. Markets are fully pricing in a rate cut in May and are sort of flirting with around sort of, I think 10 basis points, maybe slightly less, of further cuts, which is to say there's a 30% chance that, at least based on futures, the RBA cuts by 50 basis points. So it's all setting us up for that particular move. The jobs data might affect things on the margin, but ultimately it's all sort of depending on the context of this inflation data, which is expected to give the RBA the room to cut interest rates next month.
Carl, how are you seeing the Aussie dollar track at the moment? We saw that V-shaped recovery, a bit of stellar comeback, wasn't it, given how far it had fallen?
Yeah, and arguably, the Aussie doesn't spend much time below 60 cents. First of all, it generally indicates if it does drop below 60 cents that the global economy is heading towards some kind of a recession or a very significant slowdown. We were there briefly, just like equities. There was some technically oversold conditions and some stretch positioning, which meant that when we did see the Liberation Day tariffs, some of them paused, and then over the weekend we saw that kind of winding back of tariffs on semiconductors and other tech components. That we got this sort of face ripping rally. Realistically, there's a couple of elements to that. There's the hope that maybe the global economy won't slow down quite as significantly as initially feared, or at least at as much as it would have had the original tariffs remained in place. There's also that kind of weaker dollar story where money's flowing into the Japanese yen, the Swiss franc, the euro as well, and that's that kind of crisis of confidence that's going on at the moment in US assets, as well as obviously the market's pricing in that the US economy will be hit hardest by any kind of trade war because obviously the tariffs are most applicable to the US. So we've got the Aussie back at about 64 cents. I will say I think the US dollar looks in the short term quite oversold, and I think the bounce back that we saw last night, especially going into the Bank of Canada decision and an ECB cut in the next couple of days, could be a little oversold itself, so we could be due for a little bit of a bounce. Ultimately, I think the Aussie will continue to trade according to these kind of global growth impulse. But for now, again, the relief rally, that tariffs won't be as severe, and that effectively the US economy is going to be biggest hit, and there's that crisis of confidence in US assets, is supporting the Aussie dollar as the greenback falls as well. So very interesting dynamic, remains a proxy for global growth. I can't see it ripping much further from here, but certainly will remain supported if those other dynamics continue to play out.